That's what I need to say, so I'm going to hand over.
Thanks, Sue Ellen. So yeah, as Sue Ellen said, we're Rawson Baker Advisors. So we're fully trained chartered accountants. We've set up a new advisory and accounting business based out of Tamworth through the SRI. And yeah, Sue Ellen nailed it on the head. A lot of the stuff that we've been asked to cover today, we've either been advising clients on for the last 5, 10, 15 years, or we've lived it through our own journey to get to where we are and constantly keep reviewing these things. So hopefully we have a decent amount of insight for today's session. Yeah, I guess what we do really quickly, as we said, chartered accountants, advisors, we set up our business to try. We saw that there was a big hole in terms of what a traditional accountant was delivering versus what we wanted to actually do, which was help a business succeed. So we've identified that, and it's case in point is what we're doing every day, picking up these clients and helping them actively in the business, not just doing a tax return, seeing them 8 months after the fact, and then saying I'll see you next year. It's not really how any advisor should work.
So yeah, so the budgeting and cash flow management piece is very much the bread and butter of what we offer as a basic service. So yeah, just a brief outline of what we'll go through today. It is very much about going through the budgeting process. So this is a 101 series of presentations. So we're going to break down preparing a budget, from the ground up, and then we'll talk about how a budget can be used in managing working capital, which is cash in the business. How a budget can help us with measuring success, and then we'll touch on the topics around entity structures for a startup or an SME business. Some compliance considerations and also some funding options.
We've tried to deliver this session so it's a little bit friendly as well, guys. So if you've got a question that you want to ask, just let us know, throw a hand up or interject at the time. We're also going to try and give a little bit of time for Q&A before we move on to the next topic. And then we do have that blanket for the end for Q&A. Some stuff we might not be able to talk about if it's bordering on advice to your specific circumstances. We don't want to get sued, and we don't want the union to get sued. So that's a follow-up meeting that we'll have afterwards if there is anything that breaches there. But for the most part, yeah, we're trying to get that engagement. So I've found in the past that, as a participant, I get a lot more when I can talk about a problem and work through it that way. So yeah, feel free to throw your hand up.
Yeah, feel free to butt in if you've got a question.
Yep. Cool. First up, we're going to just basically dissect the key components of a budget. So you guys all have I think there's one that we're going to pass out now. You've all got that little pack, which has the budget that we're going to push on to next. And the entire session today is built around the same numbers. Just want to drop one over there. Yeah, so our entire session is built around this same sort of data set. So it's not jumping around, but basically, within a budget, you've got the three main components, which is your income, your direct costs, overheads. But what really makes a budget, what you want to use to create a budget is the assumptions behind it. So for doing your own budget, to just check if a business is viable, you want to be saying, you don't want to just sit down and go, I'm going to go sell some hats, some I Love Armadale hats. I think I'm going to sell heaps of these hats, probably a couple 100,000 worth in a year. What you want to have is, okay, month one, I'm going to sell 10 of these hats. The price will be $10. So that'll be $100 in my first month. Month two, I'm going to sell 20. That's what I mean by assumptions. So it's actually how are you quantifying the figures that have ended up in the budget. And those are the kind of things that an investor, or if you're looking for an investor or a business partner, they want to know that you haven't just plucked these figures out of the air. They want to see that you've had real thought has gone in behind these numbers. So it's really the key component of an assumption and budget. Do you want to go on direct costs?
Yeah, so as Andy says, line by line on a budget, these numbers are made up by assumptions. So when you're so income's a pretty easy one. You're selling 100 hats at $100. Direct costs, similar thing. So it can be a derivative of your sales number. You need to buy a certain amount of stock to sell, or you're employing a certain amount of staff to produce a certain amount of service or product or service. So I guess the main thing that we're trying to get across here is a budget. Like, that's a very pretty looking document, and it shows that at the end of the year we're making a nice little profit. But anyone who's educated, who's looking at this budget, they're straight away going to be asking what's behind this. So the assumptions allow you to kind of tell the story of the business and how it's going to, how your kind of idea is going to monetize, and how it's actually going to work and make a profit. And that's important, not only for if you're looking for funding, if you're going to the bank or you're going to an investor, but it's also important for yourself, because if you've got an idea, you really need to know, if you're looking to go into business, you really need to know whether the numbers are going to stack up, and you need to know pretty early whether you need to make changes around what you're doing. And so building it out with these assumptions line by line, you can find out what is working and what's not going to work, and whether it's going to work at all. So we might flick on and have a look at this budget. So
this is pretty much what everyone says accountants shouldn't do, just put a bunch of numbers on a board. So sorry guys, but this is the activity as well. That's why we've thrown it up here. Really quickly, even if you just look down the bottom line, you can see the first 6 months-ish, it's operating at a loss. So instantly you can see, and that's a reality for a lot of businesses, but a budget, as well as checking if you are ever going to make a profit, it's going to let you know how much money you need to even get into the business to begin with. So what kind of cash injection or savings you need to bring in to open the door and keep running and get to that future profit point. And for some businesses, so tech sector especially, you're not going to make a profit for potentially years. So this is if you're pitching to investors, you're going to have a 4 or 5 year budget plan, which is going to show that profit point. But and then I guess breaking down, you can see up the top here, income line, you might have a couple of different variables there for different products that you're selling, but in here we're just using this hat example, and you can see that we've pushed it up, which would hopefully align with marketing or additional sales. We haven't just gone, I think I'm going to sell 100,000 hats in year one, and then divided that by 12, which is pretty much what the common thing to do. In some instances that is appropriate. So if we were doing like phone expenses, it's going to be pretty static every month. So it's okay to go, $80 a month is going to be my mobile. But the reality of selling hats, for example, might be it's a new business. I'm selling products now. I'm going to sell a few, then it'll ramp up. In winter, it might cool down. So my numbers will be a little bit worse. In summer, they should increase. So it's doing your budget and then having those assumptions to say, here's what it means and here's how I've got there.
Yeah. And if you go to the second page on the handout, you can actually, we've actually done that process of breaking down the income and cost of sales lines based on, and this is based on a
I don't know if we have it
so
anymore.
selling a physical product, but
I thought we did.
You get the idea of how, from a budgeting point of view, how we've come up with these numbers line by line.
Just that. So you can just print 2 of them.
And this is a pretty basic example, but you can see under the income assumptions, we're assuming that, over the 12 months, in the first month, we don't sell any, but the number of units that we sell over the 12 months steadily increases. And that's a fairly important basic assumption for any businesses, knowing how much you're going to sell and over what time period.
Mm. And
similarly, buying the units, like if you're buying and selling, you've obviously got to buy units to be able to sell them. So that also becomes pretty important.
We haven't included it on this slide, but you're going to get a gross margin percentage here when you're dealing with sales and direct profit. and sales and direct costs, sorry. And that's a percentage that's a good indicator for a business. If that's fluctuating really heavily month to month, it means that there's something wrong in the process, whether you've assigned an expense to direct costs that should be in overheads or whether there's something that isn't getting flattened out that needs to be. You kind of want your gross margin to be as strong as possible, because that's what the profit is left after the cost. Like those hats, I'm buying them for $50, I'm selling them for 100, so I've got $50 left to pay for everything else and then pay me a profit. So it's a good initial indicator on how the business is doing. And as you ramp up production, so if I'm buying 20 hats in month one, I'm not probably going to get a great price, but if I've ramped that up to 200,000 hats, that should improve my gross margin because I'm going to get a better buying price because I'm getting more stock. So that's sort of a little bit of the relationship there. The operating expenses, if we head down there, in the activity we've got, it's we've left it intentionally blank, a lot of these lines, but here's a few examples of what you might come across and when they're going to hit. So part of the budgeting process is thinking about month to month when these costs are going to come up. And you can see month one, we haven't sold any hats. We've copped a fair bit of expenditure. So legals is jacked up instantly, and those are the things that you've got to really think about. And it's part of that budgeting process is sort of looking beyond, I've got this great idea, I know people want it and they're going to buy it. You've really got to have a genuine think about what expenses are going to come up, because stuff comes up that no one ever plans for as well. So it's not even a bad idea to have just a column for $500 for random, stuff that I don't know about. But doing a bit of research will help. Splitting it out,
so having these assumptions line by line, but also month by month, it really makes you think, what could happen. So in this example, if you're starting up a new small business, you probably don't expect that over 12 months that you're going to spend 14 grand on legal fees. But if you're, especially in the startup space, if you've got a new idea or something that's a bit different, the chances are you're going to have to spend money on maybe IP or registering trademarks, things like that, and that can become quite costly. So so breaking down your budget in this manner allows you to kind of cover all your bases and and be a bit realistic about what might be included.
And when I was mentioned earlier about doing a budget for a couple of years, so if we're selling these hats out of mum's garage, I'm not paying any warehouse costs, I'm not paying any staff. Year two, presumably I don't want to be out of mum's garage still. So you need to be thinking about, okay, year one, I might be making a lot of money or getting to that point where I'm making more profit so I can pay for the garage, so I can pay for the rent. Just because you're not doing it now, like to get to that next profit point, what are you going to incur? So it is a handy system to see, is this viable to begin with? Should I wake up? Should I quit my job to earn nothing? It is a starting point. Simon and I went through this exact thing at the pub one afternoon. I think it was the second conversation we had about Rawson Baker. Like, is this possible? Are we nuts?
And it's not an easy process. Even though we force our clients to go through this process, forcing ourselves to do it was pretty hard. So we understand that it is a bit of it's a hard thing to sit down and do, but it's an absolutely necessary thing to do.
Yeah.
And even in your personal life, like if you're quitting a job to go and start a business, you most definitely need a personal budget as well. So because after all, you've got to cover off. You don't want to be eating baked beans all your life.
Forever, yeah. They're okay for a couple of months.
Yeah.
So when you do this operating expenses, if your product you're selling or whatever is mostly operating costs, so it looks like that's mostly monthly operating costs, whether you're sort of selling much or not.
Yeah.
When you're doing that table, do you do it as whether I'm selling stuff or not, this is the table, or and all those costs going into the cost of sales?
No, it's a good question, because it really depends on the nature of the business. So, for example, advertising, like marketing could be considered a direct cost because it might be essential, like there's a direct correlation between marketing and sales. And the same with wages. Like if you're a professional service or if you've got
to hire an extra warehouse person to ship when you're busy, like that'd be a direct.
That'll correlate direct.
Yeah.
So is that still going that table? Like, is that sort of everything in that operating cost? Because I suppose I'm asking because we have costs that we only incur that operating costs, for instance, laundry or whatever, that are related only if we sell hire out our services.
Yeah.
So that'd be a direct cost.
That's
yeah. So if you weren't selling, like the way to think, if you didn't sell anything, would you incur it? Yeah. It's kind of the more you sell, the higher that purchases or the cost of good sales will increase. That's kind of the relation.
So it's not.
Do you split it out like that? Like, would you put the laundry say in there based on the number of sales that you assumed at the top?
Yeah. So under the cost of sales, you can have, like, we've only got one line there, but basically what happens is you'd actually just.
You'd take laundry from there and stick it up the top. Like we've only got one line, but you might have 30 lines. It doesn't have to just be purchases. Like for sales, like for our business sales, we've got like 17 lines.
But so the operating expenses are pretty much, this is what I need to do.
If I'm not selling a thing, I'm still going to pay this money.
Yeah.
Yeah, like rent's still going to happen. Like my website fees are still going to be there. It's the ones that as you increase production, they'll ramp up. And we didn't touch on it yesterday actually, but we did a while ago. Talking about hats is pretty easy to justify, but if you're in a professional services environment, the assumption you're going to want to think about, especially for income, will be different. So for Simon and I, for example, we went, okay, our charge out rate we estimate would be, $300 an hour. We think that we could have X amount of hours per week. 80% of that we estimated as being productive hours, billable. So that was how we build our assumptions out, except then it was like, righto, but we don't have clients to begin with. So it's thinking, so we use the hat example in this situation because it's usually sort of easier to explain, but when there is whatever business you're in, like you've got to think of it in a way that makes sense. So if you're doing it, if you're selling something, but it is based on hours as well, you've got to have the multiple assumption in there.
And wages is the perfect example. Like a business might have, like you might have an admin staff or a finance staff or a receptionist who's there 5 days a week. So that'd be an overhead. Whereas if you've got someone who's
like an income generator,
website or generating sales, so you might have a wage line under operating and a wage line under cost of sales. Yeah. So it really depends on the circumstance.
Cool. Any more questions there before we're going to do an activity, but before we break into the activity? No? All right, let's just do it then. So the activity, if you flip over, I think to the 4th page there, so we actually have, there's two last pages. One of them has a 3-monthly budget. We found out that takes way too long, so we're not going to make you do a 3-month. There's another one with just a single line for June. So that one. Yep, so it's the one that doesn't have the green on it for reference. So what we'll ask, since you're all in nice groups on the tables anyway, you can do this as a group, but if you prefer, you can just do it individually. I found that it helped to do this activity on my own business because it's good to workshop your own business when you have time, but if you want to just make something up, pick the hat example if you want. So what I'm looking for is have a crack at an income line, an expense line for your business or a made up one. Like just put in a figure. Then what I really want is the assumption. So so you've got $100 there as your income. How do you have that? So think about the assumption and present it in a way that you would be presenting this to an investor, if that makes sense. So it could be your business, like I said, or it could be just pick anything from a hat. So for income, you might say, I'm going to sell 100 units at X dollars. That's your assumption. And that's fine. For direct cost, what it might cost you. For operating expenses, it can be pretty varied, but it might be, my admin will cost X amount of dollars on this salary regardless. So that's your assumption. That's how you've got to the figure. Or it could be, last year my electricity was $2,000. I've looked up the increase estimate for this year and it's 3%. That's hence my electricity cost.
And we've left.
In fact, you shouldn't be doing some sort of risk analysis. I mean, there's so many things floating around, like inflation, state of the economy, how fast it's growing,
Yep.
value of the Australian dollar, because of your imported goods.
Yeah. So when we talk about assumptions,
And,
that's
would all of this be in your assumption?
is spot on.
Yeah, so this really, I mean, originally we did our presentation based on what you're going to be having for presenting to an investor, and it was like, you know, part of my investor prospectus is a budget. The step before that is my market research, which leads into your assumptions. So 100%, but it's.
But if you're going to do some sort of risk analysis, presumably you want to put a degree of probability on each of these things happening, and then you could come up with perhaps a best guess.
Yeah. Yep. So
you just discounted. So if you said, well, look, there's a 20% risk on my income, then I'll take 80%, probably say $100, but actually I'm only going to count $80 towards that. And there's an upside there of $20, 20%. So it would be relatively straightforward to include that analysis in. And like you said, the Australian dollar, if your business was based in Armidale and only working with the US, then you could put that discount right at the very bottom, because all your fees and everything else will all hit that same discount. Or you could, if half of it was to US and half of it was domestic, then you could put that discount in.
With working overseas, so I have a client who imports and exports, and we've worked on a couple of different models, best, worst, and mid-case range for a budget. So we actually set 3 and base an exchange rate fluctuation on that. And it's good to see those best and worst case, and then pick a middle point or somewhere middle and low, because it's worthwhile noting, especially if you're in a low margin game, that if something horrible happens, that you're not dead in the water. So it's admittedly doing a full risk analysis for your average SME and business owner it's not their tool shed. It'd be great if everyone could do a full thing, and even doing market research before they get to this point doesn't often happen. But sitting down, doing a budget and thinking about the numbers more than just plucking it out of the air, that's the big consideration. And then I
think, like, from a practical point of view, dealing with this process with clients, we say, right, you could spend 6 weeks preparing your budget, going through line by line and doing a massive analysis on every line item. But if you spend that much time, what's the reward that you get out of producing this report?
Could that be 6 weeks you could have been selling?
From a practical point of view, yes. It comes down to the skill of the business owner and how much time they've got. So there's kind of a
cost benefit.
It's kind of a middle ground where you prepare this. It might be reasonably high level, or if the business owner wants to, they can make it as granular as they like, depending on how much skill and time they've got. Yeah.
You have to be careful when you're making your assumptions. You don't have like assumptions on assumptions.
Well, that's what I'm talking about. Like, you can, because a budget is at the end of the day, you're predicting what's happening in the future. So the unknown.
I mean, who picked this drought was coming is an example. So it's 12 months ago, we probably wouldn't have thought it was going to be the worst drought for all of New South Wales.
And the next section actually talks about taking a budget into a rolling forecast. And what that means is you can actually fine tune your assumptions as you go. So whereas
is that where you sort of put in, okay, well, last month we actually had this many sales?
Yeah.
You put that in and go, okay, well, I might change.
Or you're 6 months down the track and the Australian dollar is 20 cents. So obviously your assumptions have to change.
So it's just sort of like the data that you've already got to.
Yeah, correct. Yeah.
Another assumption, of course, is that, another issue is the originality of whatever it is you're selling. I've spent a lot of time swanning around Silicon Valley, and there people come up routinely with completely out of the box ideas which no one has ever seen before.
Yep.
And there the culture is, of course, let's do it anyway.
Yeah.
Irrespective of the outcome, which is why 85% of the startups in Silicon Valley actually fail.
Yeah. Well, I don't think this budgeting process can help those people, to be honest.
Yeah.
Because
So,
Sorry.
yeah.
For this exercise, are we putting startup costs or is it actually just operating costs for the month?
Do whatever you want. So if you were going to look at a startup cost, for example, that's going to be an op cost, and I would hope for a brewery, for example, you've gone and scoped out how much the VATs are going to cost, and maybe got a quote from 2 providers. So, and that's that assumption base. So startup costs, you might go see a lawyer or an accountant, go get a quote. Like, you don't have to walk in the door and pay straight away. Go get some idea on it. That's what it's. Yep.
Just for assumptions, say like you're putting in a application with Bank for Finance,
Yep.
and based on like market research, say my sale would be 100 per month, based on other
100.
research.
Yep.
Is it still, because I've started my application already, but I've started it at 60 because I didn't want to assume just because other people have
Yeah. No,
sales.
perfect. So you've gone
So
a.
even if I go in at 60, then I've still got, like if I show the bank at 60.
So it'll look like.
That in my assumption.
Yeah. So what I'd probably do is say, look, per my market research, this product, this widget is selling at approximately 100 units per month, because I'm a new entrant, or because, to be conservative for my budgeting purposes, I've gone 40% below, which is something that smart to do anyway. The only thing you don't want to do is purposefully set yourself a low sales target because it means that you're not going to drive yourself. It's the one sort of counterproductive part, but
Well, I just want to check. No, I'm still aiming for 100.
yeah, no.
I'm the one who, like, put in a thing that says, oh, you know, I think I'm going to make this much.
And then
for the
never
first
hit it, yeah.
12 months, you only make 60.
Yep,
And,
yeah.
Well,
Yep.
As long as you're paying them, I suppose they don't worry. But,
Yeah.
just because it still shows a decent enough profit above my break even.
Yeah, and a bank or an educated investor will do that exact thing. So if you went in and put 100 in your budget,
Yeah.
they will take your budget away and put a line through it and say, no, actually, let's just work on 60 as a conservative amount to make sure we're covering our backside.
Yeah.
So
it's
what you've done
important.
is like it's a sensible thing to do because that's what had happened anyway.
And make sure with these assumption pays, give that assumption page to your investor. Yeah, perfect. So yeah, no, bang on. Because if the bank, you don't want the bank to go take that 60% figure you've got and then reduce it again. You want them to know, no, I'm working off conservative numbers for this reason. It's not that you're only estimating that you're going to hit 60%, but you've given yourself a sort of a worst case scenario, and it still shows a profit.
I'd just like to make an observation here. Banks seem to be very conservative.
Yeah.
Especially with startup organisations, which they're no worse to be happy.
You usually need a couple of years trading.
Again, coming back to Silicon Valley, where in fact most of the startups would be using venture capital rather than banks, you can make an entirely different set of assumptions, which are much looser, much more ambitious.
Yeah.
Well, it's a different kind of. You're proving to an investor they're going to make money, whereas a bank just wants to make sure that they're going to get repaid their money. They're not going to get a jackpot at the end of the day.
So I guess here in Armadale we're talking about banks.
Yeah.
Next to no venture capital.
Yeah.
Yes.
Angel investors. We do have some information that we'll give on different funding types. But we ran through that originally of our first presentation, but it wasn't too relevant. So we've stripped it out, and it's just going to be a takeaway for everyone. And it's honestly an entire different session in itself. So we're going to go around the room. Who's got an assumption for us?
Or do you need a minute to put a couple down? You don't have to do it definitively. Just maybe pick out a couple of lines and something that might be applicable to your situation. And we'll just give you a minute or two.
Yeah. We might be low on body everything, potentially. So Hugh, is this being thinged?
Hey.
Is this being on Facebook Live or not?
Oh, not at most. So we're just recording the Zoom. So basically,
Okay.
I'll go back and edit just because it's a workshop kind of nature.
Yeah. Cool. I was just like, do we need to have a laptop up with comments and stuff? No, all good. Righto. $20 seconds. Oh. I parked so far away. I'm like, I'll just swing back and get you if you want. All right, that might do it, everyone. We've still got a bit to cover. So who wants to? Exactly, Hugh does want to. Righto.
Are we just talking about sales?
Any. So just so let us know if it's a sale, direct costs, or overhead, and then
Choose one that might be more relevant to your situation.
Okay,
Yep.
I just said that with our current setup, we can sell 16 kegs a month, and that's like our limit. That's brewing.
that's max
So
capacity.
It takes 2 weeks to ferment, so
Yep.
you're capped in that regardless. So you can only do 2 brews a month.
Yep.
Can't change that.
Yep.
And then the cost around that is more market cost, basically what we're getting.
Yeah, cool.
That's and then the assumptions can work backwards from that, I guess.
Yeah. So you've worked out your capacity, which is perfect. And then what you would want for the income line is, because you guys might already have a trail of historical stuff that you can rely on, but otherwise it's, I can't sell more than my capacity. So yeah, perfect. Tony, did you have?
Oh, I've just been working on sales. There's massive things that go wrong here, things like consumer sentiment, state of competition. Supposing a new business starts off doing exactly the same as you.
Yep.
So I think that's very important. The whole issue of, as I said earlier, economic growth, it also affects consumer sentiment.
Yeah, and I suppose from a practical point of view, we're kind of using that as background, but for the purposes of building your budget, you're probably looking more to.
I've done my risk analysis. I'm doing this business. What's the budget?
What you think you're actually going to sell.
Mm.
So in a unit. Yeah. So that's the kind of we're talking about practically building this budget and coming up with the number that you put in the box, basically. Yeah.
Who else wants to nominate? Anyone have an overhead assumption? Or anything?
So we operate a glamping, so we set up tents for public accommodation.
Oh yeah.
So one of our assumptions, restrictions is the number of weekends. So similar to use one is like the number of weekends actually available. But also sometimes the time in the day. So if it's a 4-hour trip there and a 4-hour trip back, we have to worry about, okay, well that's an 8-hour day already.
Yeah.
Can we actually spend 6 hours setting up tents in that time? So we have some restrictions around how far we can actually travel as well.
Yep.
Based on that, because obviously it starts to get very expensive if we're paying our staff to have accommodation. That's the stuff that starts to get a bit not viable for the further away places. So it's some of our assumptions.
Yep.
Yep.
Yeah, cool. Anyone from back there? I can't see name tags, sorry guys.
Sorry. We are going to do the seminar next month. So we have assumptions that we will get some students from seminar.
Yep.
So on the basis of because we haven't done yet,
Yep.
we are still in the startup phase. So on the basis of that, so we'll get the students and they pay the fees and then we'll contribute the.
Yeah, okay. So if for your example is it's, you have a set fee per student. So the income would be as a starter, my sales are X dollars per one sold, and I might sell it. Like if you're thinking that you might be generating a lot of income off the back of these events, when are you having the events? So if you have them 3 times a year, then you would expect a boom right after that. Like, so, you know, you might have it in March, and then in April, there might be an increase in sales due to that marketing event. That's kind of how the assumption process might work. Yeah. Anyone else? Thanks. That's super handy.
I just like to observe here that you're talking about purchasing. And this just assumes that in fact the argument is for selling, but actually purchasing. But if you're in the business of making your own stuff, there's a vast.
There we go, guys. If you want to put name tags on.
Yes.
The whole economy is scale.
Yep, spot on. So that's a good point. So if you're buying a lot of smaller components to make a saleable item, then your assumptions around buying your inventory to make a good work in progress good that goes on something that's saleable, that becomes a lot more detailed. Yeah, you're spot on. Yeah.
Yeah.
And then the third example, as we spoke about, was if you're not selling a physical good, it's actually how do you account, how do you cost for your time, essentially, because your time is what you're selling. So that's a good point.
And that's why I usually use us as an example, because it's an easy and lazy answer. So for us, we figured out our capacity, exactly the same thing Hugh did, and then we were like, okay, we've got all this capacity. Do we have clients? So it's working out that next part. Because it's great having capacity.
So you basically, so to explain that, look, you've got to basically reverse engineer. You've got to say, how much can I sell?
So I can sell this. What can I realistically sell? So I can manufacture this. I have hours in the day to do this. And then what's the market appetite, or what can I physically then deliver? And then you've also got to consider, okay, I'm a new business. There's not just me selling things. I've got to run admin. If you're a sole trader, I've got to set up bloody email. I've got to manage my website, my SEO, call contacts. Like there's a lot of other things. So that's why when you're working out your capacity for a service business, or if you've got employees that are on the road for 4 hours, like it's thinking about those time considerations that are taking out.
And that can pretty soon show you whether you're pricing correctly or whether your business model is viable.
Yep.
There's another element here too, called quality of service. And you can have businesses that are selling things that's slightly less than your service, but because your service is so much better, people will come to you.
And that's part of that first step in doing market research and figuring out what your product is, how you're selling it. Like if you want to get into the market, you might do, the price leading strategy, go in low and then reassess later, and that's that first step which builds onto your assumptions. Yeah. So off the back of that, we've done the budget. We figured out if we're going to make it a profit and loss and when, month for month. We've got our payback period. So that one's important in terms of figuring out, okay, I'm not going to make a profit for 18 months. How am I going to eat? How am I going to pay for these running costs for the business? So do I need a loan? Do I need an investor? Or is this a dumb idea? The reality is you've got to know these things. And then funding required is what it is. And there's different types depending on the business that's appropriate. We're not going to really touch on that today, but we will send around a little bit of info because it's probably a whole nother session. And leading off the back of the budgeting process is working capital. So we've got another fun activity here, even more fun than the last one. But
so working capital basically is working capital is the cash in your business. So obviously, a business needs cash to be able to operate, and this is a very, very important, very important topic. So working capital is basically broken down to cash at bank. So physically, how much cash you've got in your bank. And then the two at a higher level, the factors that affect this are money owed to you. So when you're selling your item, the money that's owed to you, and then money that you owe. So paying your suppliers, paying the ATO, paying yourself. And then, so we're going to touch on some strategies around this. So we might flick to the next, and there's another next handout. So what
Hopefully we've got enough of
here-
these ones.
So basically, we're using the exact same data that we've put in our budget, but we've added another section, what we refer to as below the line. So below the profit line, we've got non-profit and loss items, and this is a very like in our experience with new businesses, this is one of the main areas where small businesses get really stuck, and it's managing cash at bank. So in this basic example, we've done our budget, and we've worked out that at the end of the year, well, month by month, we're making a loss until about February, and then we get to the end of the year, happy days, we're making profit. But when we then add on the cash flow implications, even though this business has kind of started slowly and is making a profit, we actually run into a cash flow. We actually run out of cash in about 8 months into doing business, and this is a very common thing that happens.
And if you look at February, that's so 24. You should be stoked. That's the highest sales for the month. You'd be like, great, I'm going to have bulk cash. But yeah, as Simon pointed out, this is where a lot of businesses get tripped out. You might be making those sales, but the dollars in the bank aren't reflecting it.
And when you hear about stats about a certain percentage of small businesses failing within the first 2 years, the majority of the failures come when they accrue, especially ATO liabilities. They run out of money, and the ATO comes in and says, thanks very much, we're taking everything you've got to pay your GST. So I'm playing a bit of devil's advocate there, but this in practice, this is a real thing, and it's and it very much comes down to lack of education around not only the budgeting process, but the cash flow, the working capital management process. So we might just walk through this. So this business, they've put 50 grand in at the start. They've spent about 15 grand getting set up. So at the end of the month, end of the first month, there's no sales, 5 grand of expenses. They've got about 28 grand in the bank. Perfect. So what could go wrong here? But so it's okay. We're making losses for the first 6 months, but there is a few other things going on. So we've got a motor vehicle loan repayment, which is taking out $1,600 a month. But where the trouble starts, I suppose, here is come November, we've just lodged a BAS, so a business activity statement with the ATO, which accounts for our GST and our pay-as-you-go withholding on the wages. The GST and pay-as-you-go withholding for the first quarter is actually payable in November. So there's a bit of a timing difference there. And this is something that a lot of people have trouble keeping up with. So in November, it's not so much an issue, but when the sales wind up in February, they've got a massive ATO bill. And this is where they get into trouble cash flow wise. So it's very important for a small business to understand that when you're selling a good and you're starting to make a profit, you actually have to hold on to and remit GST to the ATO. And when you're paying staff, you have to withhold and remit pay-as-you-go withholding tax to the ATO. And that's the...
You got the super as well, so...
And superannuation. So that's the small business owner's obligation. And what makes it really tricky is you're not actually obliged to pay it as you go. So there's a timing difference to when those things become due.
Even though it's in the name, it's just... yeah. So it's the big thing here is we've done the P&L. We don't have that money in the bank account, and that's where those non-operating movements come into play. And that's the normal non-operating is really really the stuff that makes and breaks a business. Because if you have a bunch of stuff, and it's usually a timing issue that Simon spoke about, which is those ATO or the other unexpected. Income tax is usually pretty brutal for a new business. So, year one I've operated and made a profit. Year two I've also made a profit. I've been pretty lazy lodging my tax returns though. So year three, I lodge my first tax return, I get a 20 grand bill, and then I'm required to lodge my second because I was late, another 50 grand bill. So now I've got to pay 70 grand out of my year three profits as well as operating expense. And obviously I've blown all my cash in those first 2 years. I really wanted a new Hilux. So that's something that does cripple new businesses. It's a sort of that 30-year hangover, and it takes a while to get out of it. So it's sort of understanding that the budget is it's not just your P&L. It's then going, what else happens to impact the bank? And what we might, I think, does that sort of make sense, I guess? Does anyone have any questions there before we? Yep.
If you've done this for your own business to say, oh, I'm going to create a loss there, you can go back, because like in December, for example, the massive amount of wages that came in that month compared to like next month and month before and after that, you'd be able to like reassess, you really need to pay that much out for that sales and
Yeah.
Yeah. So we've assumed the stuff on the top has happened or is going to happen regardless. But you're 100% right. Like if you were doing a cash flow forecast, you want to look at these expenses, and the next exercise is exactly that, saying, I've got a massive lump there. Can I push that? Do I need to hire a bunch of guys to trip out my warehouse when I've got no sales, or can I wait until 6 months when I do have the money to pay for it? So spot on. Yep. Yeah. Oh, but that could have been that this person hasn't eaten or hasn't drawn a wage for the last 5 months. So they're taking a chunk because they're sick of beans.
And when we look at this from a planning point of view, if we're here in June making these plans, well, that's exactly right. There's either something wrong with the assumption there, or we need to make a change, or we take this to the bank and say, this is what's going to happen. Here are our assumptions. Can we get a 10 grand overdraft in place just to get us through this little period here? So it's more a planning tool, and you're spot on. Like
once you identify where a hole is, that if you can go backwards and go, oh, it's because I've budgeted to pay this, then can I postpone that? Then perfect. If it's already happened, then yeah, you're stuck. But yeah, bank, you're a perfect example of how you've got that result. Why has it happened? What can I do to change it? Yep. Yeah, exactly. 100%. Yeah, but even the funding headroom one, that's something the bank will love to see. And in this example, we would hope that would be pretty positive, because it's showing that you're getting out of that hole. It's just a 2-month thing. Which is pretty positive. And it's also good for you to know, like if you know that you're going to have a hole in 6 months' time and you go to the bank today, they're going to be a lot happier than if you go to the bank when you're in a hole. So
for a small business, this kind of planning process can very much help you sleep at night, because you're looking at this and you're going, okay, well, the next 3 months, we've done all the work, we've done all our planning, everything's going along well, everything's under control. Whereas if you're a small business and you don't have this, you're kind of waking up the next day going, what the hell is going to happen today? What bill's going to come in?
How do I pay my staff tomorrow?
Yeah.
Yeah, cool. So we might move on. Is everyone okay with a bit of that? We are still talking about it. We haven't finished, but the activity here is on, I feel like it's on your desks. No, it's with these bits of paper. We might just get everyone to write it on the back of that paper. So this one is working out 5.
Yeah, so when it comes to, working capital, as we said, was money coming in, money going out. So what we're asking to do in this activity is just to jot down, try to come up with 5 ways to improve money coming in. So that can be mainly around the revenue, the sales side, and then 5 ways to help control the money going out.
Yeah. So the thing to not think about here is, one way to get more money coming in is to increase sales. If everyone could just say that and do that, then there's no need to have a cash flow. If you can just go and increase sales tomorrow, tell me how. It's more about getting those terms.
Yeah,
like
things around improving the timing difference between invoicing and getting the money in.
Yeah. So if you don't have an FPOS machine, like go get one. Like that might be a way that instead of always sending out an account, you could be using an FPOS machine today and getting cash tomorrow. So that's kind of what we're talking about. How do you flatten your expenses potentially? So if you've got on that example we had before, like legal costs were $1,500 in month 1. Is there a way that you could talk to your lawyer about pushing that out over a couple of months, or not getting the full hit of advice at once? Or your insurance, can that be 12 monthly? Thinking about it that way. Even saving techniques, using a separate account. So it's have a think about five ways to improve income, so cash hitting the bank account, and then 5 ways to, I guess, delay it leaving is the way to think of it. And this is a group one, so talk amongst yourselves. And what we'll do is knock it up on, there's probably a whiteboard here, yeah? Yep, there's heaps. No, we've got markers, I think. Yep, yeah, so we'll go through that. So we'll do that for 5 minutes, then we'll have a little break, everyone. So, and Simon and I will just float around and talk about some things.
Rightio, we might start taking some of these strategies. So who had one for improving the way that money comes in?
We get upfront payment
Yep.
for our services.
Should we write it?
Essentially, if we don't get paid, we don't drop.
Yep.
Make sort of cash flow quite a lot easier for us.
Yeah,
And then you're not
that's
chasing people for time and money, chasing people.
Yep. So that's ideal. If you can charge for everything up front, that's perfect.
And that I guess one thing we haven't really touched on is it's a good idea in this stage of thinking about your business and how you run your business. Is there a way that you can change how your business operates to get money in faster? So the traditional way might be, I'm a tradie, I go out, do a job, send an invoice, when I'm back in the office, which might be a month later. Can I take around that FPOS machine and bill on site? Can you run your business differently or more efficiently to get the money in faster? So upfront payment's great, and it has a few different possibilities.
Did everyone else have some?
Yep. So multiple products to get money in faster.
Yeah, like multiple services at the same time. Like it's like if I bring in someone from anywhere outside, like I will be not only focusing on one service, I will be help them to educate.
Yeah. Okay.
So and everything.
Yeah. So what you're talking about there is increasing your sales.
Yeah.
Yeah. So
we're focusing on you've made the sales, how do you get that money in faster?
How you get
so
paid,
100%, great thing to do. It's probably in that earlier step of the budgeting. This is, okay, I've made the sale, hung up the phone. How do you get that money in your bank account quicker? So it might be before you hang up, you get their card details.
So extension of upfront payment would be like online.
Yep, perfect. Online payment portals. And even simply just adding like an online payment or a credit card facility to the bottom of your invoice is like, we've seen it have a massive effect. So, I mean, you might have clients out there who exclusively use credit cards because they get an extra 50 days to pay. So if you don't have that option, your bill could go to the bottom of the pile.
That's a smart thing to do. If say you've got properties that buy lots of sort of smaller incidentals, have a credit card that you're essentially putting off paying off things till the end of the month.
This is what what I had, and we weren't allowed to order things until like 27th of the month. Because if we ordered it then, the next, like wherever we ordered it from, they usually have like even 14 or 30-day invoices. So the invoice wouldn't come to us till the end of the next month, and then you've still got 30 days to pay. So if you find out like what their billing system is,
Yeah. It is an option, but and
it's a bit of a trap
personal
too.
spending. You don't want to get to the due date and you owe 10 grand and you got 5, and then
Yeah.
you get smacked with 18.5% interest. So yes, as long as you're disciplined in paying the balance, yep, absolutely, because you're delaying it by.
If you can use it and never pay interest, and yeah. So the other side was more about using that's using credit terms and taking advantage of it, and that's part of the money going out conversation. So paying something when it's due. So what you're talking about, like there's a lot of industries have 30 days end of month. So if I pay my bill on the 27th of March, that's going to mean it'll be due on the end of April. But if I pay it on the 1st of April, I'm not going to have to pay it until what's after April, the end of May. So I'm getting like 60 days instead of 30. So that's taking advantage of your creditors, of your suppliers' generous terms. And we're figuring out ways of flipping that. So if you've got those 30 days end of month terms, a tip might be changing your invoicing terms. So, and we've gone through that exact thing with their client.
I had a processing. They processed agricultural products, so they weren't a primary producer. They did the processing, and their sale terms were end of month plus 30 days. So they'd send off bulk product to a customer, and they wouldn't get paid literally like almost until 2 months.
2 months later, yeah.
And they were buying the raw product in, and I said, "What do you?" When I found out that, I nearly fainted. But when I then asked them what their payment terms were for their suppliers, and they said, "Oh, some are 14, some are 7." So they're paying for their product within 7 days, and they're processing it and selling it, and sometimes they're not getting paid for 60 plus days. And when the numbers are big, what I did an analysis and I said, well, bring your terms back to 14 days and put that one to 14. And the difference on their cash flow forecast was in the hundreds of thousands of dollars. It was just incredible. Just by changing the number on your invoice, your terms.
How easy it to negotiate with the supplier?
Depends on volume, honestly, but sometimes it is just making a call. And one thing we haven't put up there is money going out is having an account with the supplier. So if you're regularly buying or semi-regularly, if you just have an account, you might just automatically go on a monthly invoice instead of paying with FBOS on the dot. But sometimes it can be purely calling and asking, because a lot of businesses, if they have sales reps, they have that in their structure to give you an amount. They have like I've got 5% or 20% I can offer certain customers. So you just ask, and at the end of the day, if you don't make the call, you're in the exact same position as if you make the call. And so purely asking. Tony, sorry, you had your hand up for about 20 minutes.
When it comes to money in, sometimes I buy things using Afterpay.
Yep.
And that facility enables people to bring forward purchases that they would otherwise.
So that's a money going out tip as well. So in terms of the business paying money later, like you're usually paying the exact same amount you would to get the good up front. Money coming in, it's an option if you want to add it to your invoicing system, but like similar to having credit card facilities, you're going to incur costs from Afterpay. So Afterpay model is, you sell something for $100, they're going to give you $80, and they're not going to give it to you until, I think you don't get your first portion of the payment until 30 days after the sale. And then you get another 25%, 45 days, another 25% on the 60 days. So it is something that works, but like it's more, I wouldn't look into it for a small business unless your industry unless you're not going to sell it unless you have it, if that makes sense. So if I was going to set up an online clothing boutique and every single person in the market has it, then I've probably just got to cop it and get into that Afterpay system. And I also would have to set my prices to reflect, 90% of my products will be sold by Afterpay. So, it's kind of the devil, the Afterpay system. It's good, but we'll see how long it lasts.
Number money. So would you put, for us, we can be flexible. I don't know how the right word for it. Basically, we can, because both our products, our ingredients have a shelf life and our end product has a shelf life, we can have the advantage of lining up payments a fair bit easier if we know that we're going to buy a lot of stuff quite soon. We know that we need to sell a bit, and that we have clients that will buy in bulk and pay us at certain times. I don't know what that that comes under, but
Yeah.
just
So
Just planning sales potentially. Yeah.
I don't,
So what you'd be doing then is you're not going to be generating a bunch of stock to sit there and wait for future sales. So you're sort of going, right, we're going to generate this and then sell it at this date. So yeah, even pre-sales potentially.
Yeah, that's we know that we have a market that we can plan
Yep.
around, so we're not incurring bigger money out.
It's kind of like FIFO selling technique, I guess. Yeah. First
So
thing.
we're having those commercial arrangements,
LIFO, sorry.
we'll have the retail ones and then the commercial ones.
Yep.
Yeah, it's just a,
Yeah.
it's a safety net for us that we can just,
Yeah.
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 if we need cash now.
Anyone else? There's heaps. So
and so if you're selling in bulk, you could also offer a bulk discount. So if you buy, you can kind of tier it. So if you're buying certain products in certain quantities, you can have a discount. So that'll get them to buy more and get cash quicker.
yeah, so that's like Simon said, that's hitting it twice. You're going to get money faster, or you're going to sell more. You can also do the reverse of that. So some of your suppliers, if you negotiate with someone, you say, okay, how about a on-time discount or a early payment discount? So that might be a way to improve money going out. There's another thing you can do. Like if your business is debtor heavy, so you've made a bunch of sales but no one's paying you, you can sell a chunk of that to a debtor agency. It's not the perfect model, but some business owners can't make that phone call to say, I need you to pay me. Some people just are really bad at it. So these agencies, like they're going to take a cut, like they'll take 20, 30%, but you're going to get paid a big chunk of that money on day one, and then they'll handle collection for the rest. So
that's so different to say like a debt collection. How does that?
So
Yeah, they're kind of in between. So debt collection's more a legal process.
This is like they say it's essentially you engaging a collector on your staff. That's how they like to position themselves. It's like you're employing them to act as your recovery. Yeah, basically.
So it's more outsourcing it than.
Yep.
It's a kind of middle ground, and it's a thing that's a business model that's popped up in the last few years.
With all the online accounting platforms, like there's a few that'll just plug straight in and go, like you don't even have to talk to them, they just handle it. So, and it is like for some people who are great at doing what they do, but just hate talking to people or hate asking for money, it's a good thing.
Yeah. Or if you're a sole trader with high volume, you physically don't have the time to ring 20 people a day asking for money. So you might say, we'll let these guys clip 2 or 3% off, and they can do it. So you're essentially paying them to do a service, as opposed to taking a nasty, like a vicious type legal action, which is another option.
Yep.
That's a last.
Last resort, because it's going to cost you a lot more money too, and it's reputational stuff too. People will talk about it. So money out, like a simple one for money out is just using different bank accounts for budgeting purposes. So when we have pretty much any client and a new business, if they're going to be registered, so if you have over 5K in sales at the moment, you have to be registered, unless you're a non-for-profit. We will say to these businesses, right, go get a separate online bank account, and that's your GST account. Every time you get money in, you throw 10% into that account. And then same thing for employing people. So they're going to have an account for wages and super. So every time you do a pay run, you're pumping in that money into that wages and super account. The good way to think of it is it's not your money. It's either the ATOs or it's your employees. And then when your BAS comes up, you're not struggling. You've got that money set aside. It's there.
When it comes to money out, 2 ways of dramatically reducing your costs might be to employ people on the gig economy rather than on permanent period economy. The other thing is to go online and make your sales online.
Yep.
Yeah.
So the gig economy one probably is more about minimising your expenditure on the budgeting process as opposed to the cash out. But selling stuff online, 100%. If you're adding a revenue model in or another way to sell, that's what we're talking about. It's really about thinking how your money is coming in and out, and what you can do, what you can change about your business to make it come in faster or go out slower?
So we're talking really practical here. So if we talk about an online facility, if someone opens up an invoice and it says, please transfer money into my bank account, here's the BSB account. If someone is time poor, they're just going to go, well, I'll pay this later. But if they've got
It's got a pay now button.
It's got pay now and it goes to your online facility and they can pay with PayPal or credit card, they might be more likely to do that because it's going to save them 5 minutes. So these two are, even though they might cost you a little bit, it could be the difference between getting paid when they get the bill as opposed to going in the pile and that one gets paid Thursday afternoon next week.
Yeah, and that's something you've got to figure out for yourself. And you could price, if you go do your research on a merchant facility or PayPal or Easy Debit, anything like that, add that into your pricing structure so you're not losing out too much of a margin. I mean, the other thing we didn't really touch on here is just maybe the way you're billing people. If you're offering a service, could that be on a subscription model instead of a one-off big fee? Is there a different way that you could invoice? So for us, we don't bill clients with a massive hit. For example, we do a 12-month payment arrangement. It's kind of like a service for the year. And that's just the way that we've structured it because it suits our clients in 90% of the instances because they're getting their money monthly. And for us, we can do a lot better planning as well. So because we've got that bankable recurring revenue coming in monthly.
That's what we, for our website, we had about one of the reasons we went with him was that he had like a monthly fee for 2 years rather than paying $6,000 or $8,000 upfront to build the website. We pay a lot of bucks a month to, and like then we've got a new phone and so
Yeah, so and those guys they're good because they've gone, I'm not just going to build you a website, I've got a service arrangement that's coming in and that goes with it. So
and the similar thing with things like, especially insurance, which can be a fairly big cost. Generally, if you ask, they'll let you pay that over the 12 months generally without any extra costs, maybe an admin fee. So that's a good way of holding on to your money. And even things like your electricity, and you might be able to negotiate fairer payment schedules.
Yep. So or just pay monthly instead of quarterly. Like if stuff's hit, if you're looking at this cash flow forecast and seeing a dip, but other months are really fat, like should you be paying more regularly? Is that everyone happy with that? It's really about sort of looking at your reports, thinking about what's going on and how you can improve it.
So I just want to mention about being registered for GST, not for profit have the same regulations.
I think it's instead of 75, it's 150. I had a feeling. Is that right? Depending on the organisation.
The threshold for having to register is higher, but once you register, yes, it is the same
deal.
reporting obligation.
But yeah, it gets into advice if we talk too much about it. But some businesses might just want to register from day one because they're going to go buy a heap of gear to set up and they want to claim the GST back. So it just really depends on the circumstances.
Like a clients or customers see that you're registered for GST, then they take you more seriously.
Yeah, 100%. Yeah, you seem like a real business. Yeah, it's funny that people are like that, but it's true. So, and if you're doing it from the start, it's not. It's if you've hit the $75,000 threshold and you didn't know about it until 6 months later, and then you get a call from the ATO, that's when it really hurts. So sometimes if you're starting out, you're planning on getting that 75 in year 2, it might just be beneficial to do it year 1 for that exact reason. It could be just a statusy thing. Cool. We're running really over time.
Yeah.
So
we in the package that we send out afterwards, we'll have this in a bit of detail, and that we can also address it in the Q&A.
Just out of the way. Sorry, Griffy.
So, as part of the budgeting, process is looking at what comes out at the end. So, there is a handout. So basically, when you're measuring the performance of your business, a budget is a good way to kind of look back at what's happened and reflect. And if you're using any kind of decent accounting system, you can produce a report, a budget variance
Sorry.
report, which is what you've got there.
Last again,
And
sorry
basically,
guys.
you can see what's going right, what's going to plan, what's not going to plan, basically you can then go back to your budget assumptions and say, right, what's gone on here? Did we get the assumption wrong, or did something not go right in the business? Is someone not selling enough product? Are we overspending unnecessarily? So it's a pretty straightforward report, but
Yeah, you can see variances in the report, up or down. We've got an activity here that we'll break into in a second, and we'll do it really quickly. It's basically, we wanted you to look at the variances and maybe come up with a reason, a justification for it, as if you were presenting to a silent partner or an investor. And the way I've structured it that way is because you want to keep this as professional as possible, because even if you're looking at your monthly variance yourself, it's so easy to make excuses for yourself. So if you've hit low sales and you're like, look, I was just super tired that month, or it rained a couple of days, whatever, like you can get really lazy about your excuses, and then that can roll into 2 months when you haven't hit your targets, and 3. So it's keeping it professional as if you were to present it to somebody else is really helpful. And even I think on one of our next slides, a big part of measuring success is having a second set of eyes that can look at your results. Someone, like, it doesn't have to be a paid advisor. It could be like a family member or a colleague or someone who you trust to give honest feedback about. So if you're creating this variance report and being honest with yourself about what's happened, then you can show them and they can give you feedback as well.
So just quickly, we might ask, just looking at that variance report there, maybe just ones that stand out and a possible reason, just to get you thinking about the process. So look at maybe something that's got a high percentage variance.
So purchases, has anyone got an idea of why purchases might be higher? Only made 1% more sales though.
Could be the price of the tomatoes that you're putting in, pasta sauces.
Yep. Yeah, 100%.
This is for June.
Yep.
It's the next financial year coming in, you want to buy things.
Could be a tax planning thing. Yeah. So you have a cash surplus, so that's why. So, and that's it. Like the budget, this process, you want to put in a reason. So there could be a valid reason why there's been a blowout, but you want to know it and want to explain it. Because if there's not, you want to address it. That's the main thing. So if I've gone and bought a bunch of new cool toys for the business because I had heaps of cash and I want deductions, I'm going to stick it in here as my reasoning. But if I've bought a few toys, but it shouldn't have been this high, why is that? What do I do to fix it? That's the real key thing. Because otherwise, there's not much point doing your budget and looking at all this working capital if you're only picking that up once every 12 months. You've done all this hard work to get your budget out, your working capital figures together. Now you need to go, okay, here's my actuals compared to what I estimated. What's gone wrong? What's gone right? How can I do better?
I suppose if you don't have a good reason for whatever it is, or it's like, oh, the reason is that we don't sell much in that month.
Yep.
And that's a standard thing. Then you can go back to your budget and read.
Could be a budgeting issue. Yeah.
Yeah, that's right. Yep.
Yeah.
It's just a bit off.
Yeah. So
And when you're building your budget for the next year, you actually do go back to your previous year's budget versus actual and say, right, where did we just stuff up the budgeting here? Let's get it right this year. And from a practical, like from doing this with clients for years, clients get really good at budgeting.
Yeah.
And to me, that's a win for us, because we're actually, it's not that they're good at doing a budget. It's good that in the fact that they actually understand what's going on in their business, and they know what's going to happen for 12 months. So it is it's kind of proof that it's a very important process. So
I suppose your alarm bells start to ring as if, say your motor vehicle expenses are high. You can say, oh, well, I need to get a new gearbox in it.
Yeah.
Expenses are much higher than you anticipate. You've got a good reason for it. It's not going to happen again. But if you're like, well, I don't really know why my motor vehicles.
yeah, it'll
And that's-
make
and that's-
you
Then you go, okay, then probably my assumptions.
It's either my assumptions wrong or I'm not taking enough care in the business. So I think the example yesterday, someone took a shot at us where, like, if our entertainment expenses are up, maybe we're going out to the pub too much to entertain clients. So it's looking at what's happening, like you said, and then going, oh, maybe I didn't need, like, maybe my car didn't need those sick new suspenders, or
And is there value for my product in what I think is wrong?
yeah. So it's
Is the entertainment of those clients actually turning into
a good example on this one is if you look at advertising expenses, it's 22% up. So what I'd be looking at is, okay, have I budgeted really poorly for it, or have my sales dramatically increased because of it, or is it that my last couple of months I've been way down on sales and that's why my advertising is up? Does that make sense? So there's a few things that you could be doing. Like if I had 3 months of poor sales and a low advertising expense, maybe I'd be okay, look, I'm going to go blow a bunch of money on advertising. I know I'm going to spend it. That's why there'll be a variance. And part of this...
working, I suppose, on advertising, like most people, like selling t-shirts, you do some advertising that's sort of fairly quick turnaround time. I suppose for different businesses, it's going to be different.
Yeah, it's hard.
Their advertising, 3-month turnaround time, so you sort of have to go, okay, I spent the extra there.
Well,
in 3 months' time, did my sales go up? Well, no,
yeah, so that's something with the 12-month P&L, you can draw the correlation, and that's it's probably not so much a budgeting thing, but it's having the reports to be able to So if you're preparing a budget on that basis, you should prepare your actuals on the same basis. So then you can go back and say, rightio, like that might not show up in a variance report, but you can say, I spent money in June on advertising and sales went up in August. There's a correlation. So you can say,
I mean, depending on how you're advertising, you can analyze your advertising as well. And it's just another thing for a business owner to do. But reality is it's what you've got to do now. Like see where your clicks are getting, like what your dollar is best spent on.
At the end of the day, I suppose if we take anything away from here is having these reports is absolutely essential because it's good for planning, but you can also use them you can use them retrospectively to make management decisions going forward based on what's happened. So as we talked about, motor vehicle, anything that we see going wrong in the business, we can use that information then to go forward and fix the problem and improve the business.
If your motor vehicle keeps costing a lot of money and you're blowing out, is that an indication that you need to get rid of that car and upgrade or sub it out? This part is really handy. Most businesses either aren't running any reports or they're just running a report and not having an analysis, or they just get their 12 monthly check-in with the accountant. It's really about understanding your numbers, seeing them, looking at them, and just working through what's going on, knowing what's happening in the business and trying to improve it. I think we've got there. It's that rinse, repeat, improve, and it's a constant process. So, last month you might have a comment in the business, about something that happened. Sales were down because I couldn't attend that event, or motor vehicle was up, something. And if it carries forward into next month, so you're going to refer to last month's variance when you're looking at this month's. And if it's a common theme, then that's going to give you an indication that something might need to be addressed or changed. So it is, you're going to get out as much as you put in.
Yeah.
And we haven't really spoken much about it, but it was brought up a lot yesterday about all these fancy things we've got. We stripped a lot of this straight out of Xero just to use for us, because it was pretty easy. And a point there is, if you've got any accounting system or software, it's going to do a lot of this heavy lifting for you. And look, the accounting software will cost money, but you've got to weigh that up between your time. I mean, if you wanted to generate this report in Excel, you can do it. And I've done, in my old life, I've done some really cool Excel stuff, but the value wasn't there at the end of the day for me to spend 2 weeks on these sick Excel reports that were only looked at in a board meeting for 1 hour or 10 minutes. And for a small business owner, do you have an entire day to generate these reports every week, every month? Or can you just hit run and then actually spend that time analysing the numbers? And that's what we sort of encourage pretty much for our business. Any client getting on, we don't want to see you in Excel all the time. We want to see you and doing the numbers. We want to see you thinking about the numbers and figuring out what you can do better.
Yeah. So we've got just to sum up, this part of it. Yeah, we've talked about how we can set our goals and compare our targets. That's our variance report. Andy just touched on using technology to keep this whole process under control, and also automating a lot of what goes on. So there's a cost benefit for having a proper accounting system, a cloud-based accounting system that automates your data entry and allows you to actually sit down and press the button to run your budget versus actual report. Like, you don't want to be spending a whole day coding. You'd rather be in there looking at the performance of the business. It's good to have an impartial or a second set of eyes looking at your figures.
Yeah, we touched on that one.
If it's just yourself and your business partner, you might be telling yourself a few lies. So get someone you trust, your advisor or a mentor or someone like that, to look at your numbers and get them to be honest about what's going on. Sometimes you need a bit of a kick up the bum to, you need that process just to get you back on the straight and narrow.
How often is it worth looking at your variance report? Like you said, once a year probably isn't going to give you much useful information that you can add.
I mean, do you look at your tax return?
No, at least quarterly.
Yeah.
But look.
If you've got the software, like, you can do it every day. If you're using the software, like if you've got Xero or Mob and you're reconciling daily, you can run these reports as a weekly thing. It's more how much time have you got to spend on it and what benefit's going to be there. So like monthly or quarterly is usually. And from for a small business,
yeah.
I mean, how much time do you have to analyse the results? Yeah.
And from a practical point of view, like you do your BAS quarterly, you're paying, you've got a bit of compliance. So from a practical viewpoint, it's so it's probably good just to put an hour aside and say, right, let's look at what's going on, and just make it a regular, make it habit so that you sit down and do it.
I find it setting a day. So if you're going to say, right, me and my business partner or my mum will sit down and look at the business every month or every quarter, like booking in a day to do it helps, because they're the easiest meetings to reschedule, and then they never happen. So,
we, as advisors, our minimum service offering is a quarterly, what we call a management meeting with our clients. So we lodge their BAS, we produce this report, we drive out to their business, we sit down and say, rightio, this is what's going on. Things going well, things aren't. That might be an hour meeting that's scheduled in every quarter. It's invaluable.
I think the only thing we didn't touch on that last one was owning wins and mistakes, and that's really about, if the business isn't performing, find out why and own it. Don't just make that, it's just because of what, I'll do better next month. It's so easy to make those excuses. You've got to own a mistake and say, look, I did shit last month. I'm going to change something to do better. And the same thing with a win. Like, small businesses are really bad at celebrating a great month as well, or a new client being sold. Like, you're in this to hopefully generate revenue and make a better life. You need to celebrate a success. I know you're probably flat out, but go to the movies, go take a day off, do something, celebrate a win, and own a mistake. It's just
that kind of leads into the long-term use of this kind of process. Longevity, sustainability. So if you've had a pretty bad year and you're doing the budget for the next 3 years and it's the same thing, well, is it sustainable? Like, should you be doing this, or what do you need to do to make it profitable? And that is a hard conversation to have for us with clients, but it's a very hard one to have with
for us ourselves is a hard conversation.
If you've got an idea and you believe in it and it's not stacking up on paper, it's pretty it's a bit of an emotional hit, but it is a reality at the end of the day. And I suppose that leads into personal goals. If you're not enjoying life, pursuing a business dream, should you be doing it? And on the flip side, if it's going well, by all means, take the trip to France in 5 years' time if you've worked hard for 5 years. So these are high level things. These are things you probably revisit once a year and say, rightio, is the plan?
We are better off than last year, or we're worse off, or, you know, maybe me being on a 70 grand wage as a sole trader isn't as good as my 60 grand wage in the business as an employee. Sorry. So it's stuff like that. And yeah, as Simon said, they're the annual check-ins.
And then the next one, exit strategy. At the end of the day, we're all in business to build wealth, or we should be. So even though like we're relatively young, we should have an eye on what is going to happen either when we retire, or if you're starting a business to sell it, you've got to start planning that from the outset. So, you know, is this business marketable? Am I putting enough money into super to be able to retire comfortably?
Structure-wise,
am I doing the business in the right way that a capital venturers would want to come and look at it? Succession planning. Have I got a family member who is getting the right exposure to the business to come and take it over? That's very important. In practice, we often see people who work 7 days a week, work their butts off and end up with not much at the end, try to sell their business and it's worth nothing, and it's just absolutely devastating. So when you're a business person, you've got to look after yourself. You've got to have a bit of a strategy so that you can, at the end of the day, hang the boots up and be rewarded for it.
Next one. So no other questions there on measuring success. We're comfortable. We've run pretty late over, so we have got a little bit on entity considerations that Simon will address.
When you're a startup, or if you're a growing business, it's pretty important to make sure that you're physically set up with the right structure. So a lot of people who go into business straight away think, right, we'll go and register a company, a PTY limited company. That's $1,000 straight up. But probably 20% of the time, that's actually the suitable entity. So yeah, things to consider are establishment costs, compliance costs. So a company like upfront costs a lot to set up. Year by year costs a lot more to do the annual compliance. So often, if you're starting off very small, being an individual sole trader with an ABN is quite adequate. If you're doing it with your partner, a partnership can be adequate. Some industries require that you set up a separate structure like a company for whatever reason. And as you grow, tax considerations come into it. So you might use a trust or a company to take advantage of your family group for tax considerations. So
there's also protectionism there. So if you've got a big asset that you're banking on, you might have a company to cover yourself if you get sued, stuff like that. But
if you've got IP, like if you've got a trademark, like an idea that you're going to monetize in the future, you definitely consider a separate structure. But that becomes very specific advice, and that's in professional advice territory.
Yeah. So I guess the big thing here is it's different for everyone usually, and it is a good thing to see a lawyer, an advisor, an accountant about this. Get a quote up front on what the advice will cost, and then what having it executable costs, because it's usually you can hold one of those professional persons to that cost, but it's 99% of the time it's so much better to have had that conversation up front, and it's a lot harder and potentially costly to make the change later.
Yeah.
Yeah. Yeah. It's not difficult. Just sometimes it can be a costly exercise.
It's costly because you've got to engage. At least you might have to engage an accountant and a solicitor,
potentially a business valuer,
and then pay ASIC. So it just becomes an unnecessary costly exercise.
Yeah, yeah, and I mean it's weighing that up too. Like it might be, I don't know if this idea will work. You know, maybe I won't do it quite yet if there's not too big a cost to do it later. If that makes sense. So.
If you've got a registered business name and you decide to change your company, you can't just change it, you have to deregister like your business name and then reapply for that business name.
It's
Like that,
it's still yours. Yeah.
Yeah.
Business name's a different territory. You don't lose it for 21 days and stuff, so you can have it, but like there's trademarks and stuff that's a little bit the extra level that's harder.
yeah. If you're trying to register your company name and saying that you're going to do a business name, prove that you're.
Yeah.
Yeah, it's a not. It
That's
can be-
fun.
it
It's a
can
lot
be
of fun.
Yeah.
Yeah.
Yeah,
Yeah.
that's a perfect example of that's a perfect, like that's a pretty common one actually.
Yeah,
Just
that exact one.
it's just a practical thing that can end up taking up time and money.
Whoa,
but
you can have those
with the
two.
as with the other topics, there'll be a bit more detail around
That's
around
for-
these coming out in the pack.
Tony. Yep.
So while Andy's handing these out, for any business, but especially small and startup businesses, there's compliance consideration. So the main one is probably the ATO because they're the ones who are fairly vicious when they come down on you. So there's the obvious one, registering an ABN, business name, GST if you have to, paying your income tax.
We
Might
broke.
seem pretty straightforward, but the amount of GST and income tax are the ones that bring businesses undone time and time again. So it basically is a cash flow management issue.
We broke this into 4 sections, and we've got attached to that V's buns thing is a little checklist on the back page of, you know, breaking up the sections. So we're about to hit time, so we might not go through it all now, but it is, yeah, there's lots in there. And there's also, so we've tried to just summarize some things that are relevant to these sections. Industry specific, we didn't cover. If you're in an industry, just do your research, especially like in food, for example. There's a bunch of health stuff, like an OHS that you have to meet. Heaps of different things, essentially. But yeah, there's a list there. There's also the ATO has a lot of really handy resources. If you register an ABN now, you're on like a chain for 12, 24 months. You'll get an email every quarter, which has got a bunch of little resources and tips. And we were looking at them the other day. They're actually pretty handy. Some of them are really, really good work throughs and videos. So
Yeah, we'll actually send the links to those because they virtually lay out
a lot of this,
most of these things in a lot of like very well written detail.
Yeah, they've updated all their material, which in the last sort of year and a half, which is good. And there's OzGov as well. For some reason, they both do the same thing slightly differently. Made the same material. So yeah, there's links on the back of that, but you'll get the email as well. We did have an exercise here, which was to go through a burger shop that I created, V's Buns, and we're going to look at this exercise and everyone was going to sort of workshop what are some of these considerations that would be relevant. Because we're at time, we might not do that unless everyone's super keen to do it. It's I'm guessing not. I'll leave that with you guys. Did you want to spend?
It's up to you. It'll take 5 minutes,
but you can do it at home too if you prefer.
Go, that's fine.
Well, Tony, you had to go half an hour ago, so no. Didn't you have to leave?
I'm looking at my.
Yeah, no worries. We might wind it up.
Yeah.
But if there's any, we will take a few questions. Like we'll be hanging around, so please come up and ask away about anything if you need to.
Yeah, and we've got our cards here too. So if you've got, feel free to grab a card of ours. If you do something that you'd think of later, just drop us an email or give us a call. Until it becomes too tedious, then we want to charge you. But, it's
and we'll
send this around.
Some pretty comprehensive.
What's the next set of slides anyway?
Things, in the package that we send out post.
I'll say somewhat comprehensive. So this is what I mentioned earlier. We had this in the original presentation. We dropped it, but you'll get with the pack sort of like all these, breaking them down into a couple of pros and cons and stuff. And as we mentioned, funding is an entirely different beast, and it's a whole other presentation, really. Like, you could spend another couple of hours on each topic. Yeah, so we'll send that around. If there is anyone that's that interested, yeah, touch base to the incubator. Otherwise, thanks.
Thanks, everyone.